Why did you do it? What was the background to it? Where did it come from? Did you sit down with a list of things and go, well, things we must move into today? Did you go robo advice? Or did it come out of your ETF and broker proposition? Where did it come from?
Listening to today, everyone else is having a go, so we might as well have a go as well.
Yeah, exactly, yeah.
So I joined IG 3 years ago, although I've known them for a decade. And I used to work for a French bank in equity trading. So it was a very quant algorithmic business. It was big on ETFs. So the whole heritage of ETFs I've been very close to for my whole career. And I left the bank and took a sabbatical 4 years ago. And I went and took a year out to just be curious. I went back to business school actually. And whilst I was there, there's so many innovative ideas that come up in that environment. It's no longer people going there to get a bigger job at IBM and continue on a career ladder. It's a mix of entrepreneurs testing an idea, or perhaps rich European kids working in London before they go home to run a family business.
That as well.
But it's a good breeding ground for lots of ideas. And I personally went there to look at disruption, and I'd looked at payments, peer-to-peer lending. I was very close to.
Yep.
Robo advice we'd looked at. And if you just do an analysis of this industry at a high level, macro, it's very interesting. People are living longer. They've got a self-provision. The government's not going to help them. So the macro market's very interesting from a wealth perspective.
Yep.
Hasn't been disrupted with technology, and there's some trailblazers now starting to do it. Barriers to entry are pretty low. Threat of the incumbents to act, not immediate. When they get there, they will. And so it looks a very interesting industry. But one of the problems is, if this is all you're doing and you're a startup, acquisition, building a brand is expensive, and is it viable? And so coming out of that, I thought it was a very viable industry, but to disrupt it, it might be useful to be in a firm with funds, resources, and customers. So I approached IG, and they were talking, their leverage business at the time. So for people that don't know IG, we're a FTSE 150 company. We turn over about 500 million sterling, half of it in the UK. Profit margin on that pre-tax is about 50%, so it's a very healthy business. And we own the whole value chain of what we do. And it's niche, so there's only about 150,000 active traders in the UK, and we've got about 60% market share. So one of the questions they were answering before I went was, what does growth look like? Where'd you go from that? Where'd you diversify and launch an online share dealing platform?
Yeah, that's how I first encountered it. A stockbroking operation, which actually did make sense, because I imagine you had an awful lot of people who were using for leverage and just thought, actually, you might as well just try and sell in conventional shares.
So I think that was it. It was looking at the client base and understanding them and seeing what else they did.
Yeah.
And also as an acquisition tool, is it reaching a broader audience? But stockbroking, buying and selling international shares at transaction cost is a bit. It's a bit today, isn't it? It's a bit yesterday's product. And I think where the sophisticated investor goes is, I want to buy and sell shares, but I'm not sure I want to do it all myself. How do I build some, protection in that and have a core and satellite approach with safer investments and stock picking around the outside? So I thought IG was the perfect firm to pitch this idea to, and being, a fairly entrepreneurial fintech now, I guess, they embraced it.
So the other bit missing there, because you'd also, IG quite big on ETFs. So when you brought your broker operation out, you were always quite big on ETFs. So did that lead you naturally to robo advice, or did you actually just go there that you had a load of your clients going, actually we need a cheap, lower cost solution to the core satellite portfolio model? How did it get there?
So the first thing we did is, because we've got clients, we can talk to them. And to give you an idea, if you're, maybe Hargreaves client, I think they trade on average 4 times a year.
Yeah.
I think our average client trades 4 times a day.
4 times a day?
Yeah, the high-end clients trade 20, 25 times a day. So they're very engaged, they're always on, they're on the app, they're on the website, they're actively trading their own money day in, day out.
So why would they want a robo-advice? Logically, you just think those are the last group of people you want to...
So when you segment them, so a typical client, so we've got 150,000 leverage clients, half of them in the UK, active. They are engineers, as we heard about earlier today, software, lots of finance bankers, fund managers, and lots of entrepreneurs, which we didn't hear about today. And I think they're early adopters of technology. They're self-directed. They have the time and the means to invest in the market, and they've all got speculative, short-term wallets, which is what we're tapping into, and they've got longer-term investment wallets, which we weren't tapping into. And when we surveyed the average client who are wealthier than the average direct platform, they've got 2.7 investment accounts with advisors, and one of those 2.7 legitimately would come to IG because there's a trust and a heritage there that they would try us.
So that's fascinating. So a lot of the discussion we've heard today is about the millennials, and about younger people. By default, let's be honest, young people don't have an awful lot of money because they're saving up to buy a house and do the normal things. You don't have a lot of money to sit around doing shares. So I'm guessing your average client is probably a little bit older, but not. I mean, Killix is here. They had an average client age of 57. I'm guessing your average client age, even median client age, 40s.
So on the leverage trading professionals, they're 35, 55.
Yeah.
If we look at what we think this product will do, it'll extend it 5 years each end.
Okay.
The average client in a smart portfolio now is 39, 40.
Okay, so that's exactly the age I would have thought.
Yep.
Late 30s, early 40s.
Which
somewhere.
seems to be in the middle of some of the more sophisticated robos we've heard from today.
Now, what's fascinating though is that I would have thought that as an investment journalist, I've always been. All investment journalists know a number, and the investment journalist number is 150,000 people actively trading in the UK.
Yep.
Not just all spread betting, but active traders. And then there's a second hinterland group of about 550,000, which is that number varies. Who average age is 64, who own a lot of dividend orientated shares, and they're your kind of people who read the Investors Chronicle and Money Me. And then there's so they put them together. That's about 700,000, and we estimate then there's probably another, from a journalistic point of view, there's probably another 1.5 who dabble in and out of ISAs, typical customers of people like Hargreaves Lansdown, SJP, all that kind of stuff. So addressable market amongst journalists is, we've always thought there is no more than 2 million, and that's it. And I've never heard a number to convince me otherwise. So if we go back into that, but you've got that very active market, and I've always assumed that the very active market, I keep going back to it. Why do they want to do a robo-advice product? Why? Because if they've got a view about asset allocation, they're just going to go, well, I'm going to go long, going to go long govies or short, the cable trade, all that kind of stuff. So what I'm interested in is the psychology. Why? So they are operating a core satellite portfolio. Are they basically doing their stock puntery money over here and their core satellite money over here? Do we have any sense about how big those two pots are?
So, yeah, we do. I think the average client's investable wealth, liquid wealth, was just shy of 100,000. Okay. Yeah, we've got so many clients. I mean, we never used to say our concentration, but now we do, because in a world of tighter regulation, we look at our top tranche of clients, and they're pretty much pro. So 10% of our clients do 80% of the revenue of the fund.
Yeah.
Okay. If you look at those top percent of clients, they've got a speculative wallet that they come in and out of. Yep. Okay, so they speculate, they have children, they stop, they come back to us, and they might come back to a different provider. They're all investing, but they're not investing with IG. So when we launched the stockbroking product, and we started to message it correctly, we got lots of our existing clients putting their ISAs and SIPs with us, but we got lots of new clients. So I think we've got like 30,000 in the last year or so. The 30,000 we've got
in the smart portfolio,
in the scheduling.
In the scheduling, yeah.
And if you look at the 30,000 we've got, they're the most active tranche of the million online investors, which kind of makes sense.
That does make sense, yeah.
When we attract them, our brand would attract the more active investor.
Yeah.
And so we've got all of these existing clients to provide a service to, plus this acquisition of the more active investor on share dealing, and both of those clients are interested in either some or a significant part of their money being in a low-cost, diversified portfolio. And one of the challenges I think we've got as an industry in communicating, however close to it people are, they don't understand the fees. It's pretty opaque as an industry. And we're really trying to bang the drum about transparency. If you try and understand all of the fees that you've got with your provider, it's complex. Then you try and understand, the effective performance and the active funds in the long run, quite often struggling against an index after fees. And so if you look at ETFs as a low-cost building block, and you've got active asset allocation using those low-cost building blocks, then the message you can send on fees and compound effective fees in the long term, I think it resonates with our clients perhaps a bit more than the average consumer. And so,
I'm sorry.
We just engage with them on this message, and I think what we've seen is, it's early days. We only launched in April, but we get lots of clients that try us. We think people try this kind of product for a year. That's what we get anecdotally when we talk to them. But the amount they try us with can be quite significant.
That's what I was going to ask. So what? I mean, I've heard it's quite difficult to get off some of the platforms what their average numbers are. Some are very good, some aren't. Yeah. But what would you suggest is the kind of average or median kind of capital sum they're putting in your robo proposition?
Fred, it's very difficult to say at this stage because we've got a big spread. I think where we're quite encouraged is we've got a lot of people dropping in 250, 500,
right,
which I think is quite a big clip.
That is a big
to
clip.
Try us.
Yeah, that's a big clip.
So, one of the challenges, if you're looking at new clients and acquisition, the cost of acquisition, which everyone's gone on about today, but no one's really detailed the viability of it. But cost of acquisition is high. If you're getting a client that puts 10,000 into a portfolio and you're charging 1%, that's 100 quid a year. If you've got to build up all of these capabilities with 100 people in your office, do compliance technology, etc., your margins maybe 10%, whatever. So you're making 10 quid a year on a client. If your cost per acquisition is high, then your payback's long.
Yeah.
Therefore, you can't fund yourself. You can't fund your operational cash. So you've got to raise money, etc., etc., etc. I think so. You need the big clips, but does a big client invest in a startup? Or is he anxious that they're going to be around tomorrow because it's a long-term savings?
Just on the customer acquisition point, you as a business must know from your leverage business, which is sort of fishing in a similar pool, not the same pool, but clearly similar, because clearly there is a lot of crossover. What do you think we've heard a lot of figures quoted about average customer acquisition costs from the robo-advisors.
Yeah.
What's your sense the average customer acquisition cost is overall as an investor?
So, if you're building a brand, and if you look in marketing, you would say your brand versus acquisition spend, maybe in the early stages, 60-40 brand.
Yep.
So this logo here, sponsoring the Harlequins, the stuff we do, it's brand. Then as you get more, mature, perhaps it flips and it's 60% acquisition, 40% brand. We're probably 90-10 acquisition, and we spend 10% of our revenues a year on marketing, which is about 50 million quid. So we're a big marketing machine. We're a big technology and digital marketing machine. If we look at how we do that, we look without any geographical boundaries at the value of a customer, the cost to acquire them, and the algorithm moves the acquisition accordingly. Within the non-leverage investment space, we've got share dealing in the UK and Australia, robo in the UK, and we're looking at Australia now as a very interesting market. And you look at, forget the brands, which these new startups have to spend to develop that trust over the long term. And then the acquisition, so you're looking at SEO, so people finding you on natural search with no real cost, but then you've got to put up articles to be relevant to register on a page. There's lots of work behind the scenes. PPC, or display banners, or comparison tables. If you're quite tight and spend your money on robo digital advice and keep it quite focused rather than pensions, ISAs or whatever, £300, let's say, that's to acquire a client to get to the point of application and at least fill in the first page so he just hasn't got there by mistake. There's an intent. Then you look at when you fill out the first page, get to signature page, do the online questionnaire on suitability, then invest. The dropout in the funnel at each stage is higher. So your cost per acquisition, if it's £300 and 30% of those clients actually become funded accounts, it's maybe 1,000. If your 1% on 10,000 is 100 a year, your payback's 10 years gross, much more net. So it becomes a real problem, which I suspect is why, when the guys were talking this morning, and I know lots of them personally in huge respect, and these guys are trailblazing an industry. I suspect, you do this, you look at the economics, it's an interesting business, you go B2C, you realise the CPA is too high, you don't have the operational cash to fund that, so you either raise money and keep raising it and dilute yourself so you get kicked out by the VC, or you pivot into a B2B. And I think a lot of this pivoting into B2Bs that people are going to is, I mean, it's probably influenced by the shareholders or forced because of the cost per acquisition. Whereas ours, because there's multi-products, and some clients do go from investments, smart portfolios to stockbroking, some go from stockbroking to leverage. The leverage clients that trade in this, funnily enough, they last longer, they're stickier. And
Really?
we can see that through data.
How interesting.
So there's lots of ways that we can value the customer that.
And have you mostly got most of your acquisition, which you probably have because it's early days, from your existing pool of clients and people you targeted? You haven't really been targeting, say, the enemy, the competition, which is the robo-advisor platforms or the Hargreaves Lansdown, I imagine. So people like that would be another target group. Is it mostly coming from your existing pool, and then probably next year you'll move on to the other ones?
Yeah, so I think
absolutely.
To get scale in this business, and you have to get scale. We've got tens of thousands of active clients that are good prospects for this kind of product, and we validated it. So we're going to grow the product with them, evolve the product into new directions with them to suit their needs, and along the way we'll acquire lots of new clients, but we'll acquire them with a different cost dynamic versus the products that we do. But I think it takes the pressure off, and it's also, we've got the customer base, we've got the resources. The incremental cost to build this was small. We built it primarily for our clients.
And just fill in the blank details, you're using ETFs, you're using Blackrock's Aladdin system, which is Blackrock's Aladdin asset allocation system.
So Blackrock's very interesting. When we looked at the clients and what they know IG as, so we've got Heritage, we're 40 years old, we're listed in the FTSE 150, so worth $2.5 billion. And so people see us as having heritage, financial strength, we're going to be around tomorrow. And they see us as a technological innovator. But we don't have a pedigree in asset allocation.
No.
So through Joe, actually, so we met with Blackrock and we wanted to partner with someone on the asset allocation. So the first product that we've launched is a suite of model portfolios in partnership with Blackrock, where we're working with them on the different portfolios to suit each risk bucket. And we've even created one that is more equity, more risk for our client base.
150% risk. 150% equities.
With leverage.
Leverage.
Bitcoin.
a bit of crypto there as well.
But I think the starting point was, when we looked at our clients and said, well, what do you see our brand as, and do we have your permission to move into this space? And we did some work with Landor, which is part of WPP, and it was a resounding yes. And our clients, it was like a 40% understanding of what ETFs were, which is a good starting point.
It is actually very good, yeah.
And so we had all of those benefits, which is why IG was the perfect home to build it. And adding Blackrock from the asset allocation pedigree and being a B2B house, not a B2C house, gave an uptick on that. So we thought it was a very elegant, credible solution.
But where are you taking it next?
So I think if we look at the clients that we've got, I think, by definition, these portfolios from Blackrock are optimized. So you don't really want to play around with them too much because then they wouldn't be optimized.
Yeah.
But I think where our clients are interested in, they're interested in perhaps tweaking it, perhaps beating Blackrock. Perhaps imagine if you've got a portfolio that's equity, fixed income, and you want a emerging markets bent, and you pull a skin over it, and it twists the ETFs within it to give a more emerging markets bent, or a tech or a finance bent. And then with that bent, we keep you in your risk profile. So we do the asset allocation to keep you in that. That's something that they're very interested in. I think we met you guys this week on the peer-to-peer database you've got, because I think if you look at peer-to-peer lending, it's an asset class in its own right. We ran 3 years ago a lot of correlations with all the loan books of peer-to-peer lenders, and it does not correlate to the equity or fixed income market. So if you could put that into a portfolio for the same risk, you get a better return. Therefore, it's a great asset class. We then tested with our clients, are you in peer-to-peer? Do you know about them? And surprise, surprise, 15% had peer-to-peer investments and another 10 were considering it. So for us to put a peer-to-peer element into a portfolio product, I think our clients, a lot of this is you can dream and make the product as sophisticated as you want, but if the market's not ready, no one will buy it.
Yeah.
And I think it's important not to get ahead of yourselves, but in an equity, alternative, fixed income asset class, peer-to-peer has its place. And we're very excited that, through services that you've got now, these whole loan books are there to analyse, and you can actually do some good portfolio construction with it.
Looking just a bit, stepping back from asset allocation, do you also find, do a lot of your customers, as you're engaging with them now, do they care about all the whizzy technology, about what you can do with charts and your customer interface or everything like that? I often wonder, there's three things that really investors care about. Three or four things. The first that they care about is returns, performance, and they tend to really care about that. They do care a lot about service, picking up the phone to somebody. They like the UX stuff. Yeah, it's all quite funky and everything and cool. But actually, I'll stick with those three things. In that mixture of things, as you start to engage your customers, where are they? Because you've got a very interesting crowd of people who know their way around investing. Which do they care about in those three? Do they pick up the telephone a lot to you? Do they complain about, do they say we want better UX and better tools? Or do they go, well, actually, we want Aladdin to do a better job of getting our asset allocation returns?
So they wanted complexity, charts, technical analysis, all of the bells and whistles.
Really?
They did.
But that's quite your customer.
And that was more the trading side. And now they want smooth user experience. They want simplicity. So we've just launched a new trading platform. And rather than have you open it up and it's all singing, all dancing, now it opens up with a very basic version and you add to it as you want.
Yeah.
And I think if you look at our robo platform, it's simple. It's got lots of news and content in there, which we think is key. The news and content side is very important to us. But clients want simplicity and they want to engage. And I think if we've got clients on average trading 20 times a day, they're in the platform. Therefore, the messages, the news, the articles, the video, they want it in the platform, conveniently placed when they want it. And so I think I wouldn't expect our UX to go very complex. I'd expect it to be clean and elegant, but always being optimized to be simple for the client to understand. And I think one thing I'd say in that is if we look at the next generation of people coming through, the types of, do you know what copy trading is, like eToro, people like that? So if you look at the next online investors, perhaps the cohort behind our younger end.
Yeah. So this is maybe late 20s, early 30s.
That's what they're looking at. So you're looking at DarwinX, you're looking at eToro, you're looking at a Facebook social kind of platform where they're following what other people do and getting confirmation that way and investing, following them based on their return. So if you look at where it's going with the next generation, which is the generation that's going to inherit wealth that we need to also all provide services for, I think it's much more in that direction than let's copy Bloomberg.
And your first person today has mentioned social trading, which I think is huge, but no one's mentioned it today. Absolutely. For another last question, I'll open up to the panel. The price point is vastly important, though. And this is actually one of the reasons I stumbled upon what you did, because I was comparing the market prices in the market. And, I started off today by saying we've got to reduce the overall total cost of ownership to 150 basis points, which rather implies that without the advisor element, you've got to get stuff probably below 75, 100 bits, really, the actual product. What's the average price point?
So I think at early stages, so if we look at the different portfolios, the expense ratio and say 22 bits. Okay, so that's the ETF expense ratio. And then our fees on top range, if you're a client, from 5 bips over 250 to 65.
Yeah.
But I think what we tried to do, when I mentioned in the leverage trading CFD world, we own the whole value chain. We're market maker, we're executing broker, we're technology, we're with a lot. And I think one of the challenges if you're building a robo is you've got to outsource a lot. So you've got custody external, you've got execution external, and it gives you constraints. So we again own all of the value chain in this. So things like if you want to put money into our portfolio and the markets are open, it goes in straight away. It divests you straight away. So there's a bit about if you want to park money in a portfolio while you're working out whether you want to buy Facebook as well as Amazon, park it there, and then if you want to buy Facebook, you can move it out and it's instantly liquid. I think what that allows us to do, because we control all of the value chain, is be very flexible on price and test the elasticity. We don't think it's a real discount product. We don't think our clients want a discount product.
Okay, interesting. So you don't think you've got to go all the way down to 50 basis points and below, all in?
Because we want it to be a viable business as well. We want the industry to be viable. It's one of the biggest risks, if the industry doesn't succeed.
Well, although I'm a cheeky question, I will ask. I mean, you get your ETS from Joe in the room, so apologies, Joe. But you could just go do a bunch of futures, and then you could chop the 22 basis points out.
I think ETFs, physical ETFs. We like physical. We liked non-leveraged ETFs. We like the message it gives to our clients, and our clients understand it. Yeah. So.
Happy to see
we've got SIPs. You can put CFDs in SIPs, but we don't. So we've chosen to go this very conservative, non-leveraged physical route.
Very interesting. Any questions? I'm sure there must be some questions. I've got another question. Any questions in the audience? Come on, there must be some questions. Yeah, Joe.
You also have come from this world as such. What's been the most surprising thing you've seen since you've come into the sort of world of wealth management? In that respect.
I think you hear a lot about, we're going to disrupt this industry with technology, and the incumbents are not going to respond, and the banks are not going to get their act together. I think there's some, there's a disconnect, I think, between the existing business that own the client, right? So you look at the B2B models, do you own the client or does ING still own the client? So the banks and the incumbents own the client, and they've got time, and perhaps they're just watching this industry to see how it takes off before they actually come out with their own, because there's no race on. So I find that there's a lot of people not necessarily getting on the bandwagon because it's an interesting market to be in, but I'm not sure what, in a robo side, I'm not sure what their goal is, what their exit is, because unless you scale and start to make some money, at some point the VC's doors are going to be closed. When they close and you're raising money and it's down round, on a valuation perspective, it's perhaps the beginning of the end. So I think there's a naivety in the robo world that it will all work, and I think lots of the incumbents actually probably know that and know they've got a bit of time, and so it doesn't surprise me actually. It doesn't surprise me that they're taking so long, because I don't think they're taking so long because they can't get their act together. I think they've just got time because they own clients.
What if you had to set a target for the business in terms of customers? What would you like to set it?
Number of customers.
Yeah.
So if we're 60% of the leveraged trading market, and the online share dealing market's 1 million people, I would have thought if we want to be at the top end of that, I'd like to take 10% of that.
Oh, the million.
Yeah.
100,000.
Yeah, and we've got I think 30,000 already. But as long as we don't want to dilute it, I think our brand suits the more active trading end of the market.
Exactly.
So I think if we could do that, and we get clients. So if we're looking after their speculative and investment wallet for this online kind of holistic product, I think we want to stay very much in that.
So presumably your real target actually in this is actually probably the other D2C broker platforms, the self trades, the Sparkly stockbrokers, because they've got active investors on there, and they're probably more your target group, to be brutally honest, in what you're looking at, than the SJPs and the Hargreaves Lansdowns. Yeah. Who've got long tails of personal finance customers who don't really deal very much. That's probably your target group, isn't it?
Yeah, no, if we look on, so we do 500,000 to 1 million trades a day. 99.6% are without any human intervention. So I think to make this scalable, we've got lots of people around the world that service clients 24 hours a day that can help clients, when they need help. But to make this scalable to fit our brand, it's an online business. So we're targeting, that end.
Okay. Any other questions? So.
2 questions. So on the scaling customers, obviously the reputation indirectly took a hit with respect to the churning that the UK government kind of suggested was in the marketplace. So question mark about whether you can actually expand into a broader marketplace, because maybe you don't have quite the same brand there. And the second one would be, do you see that the government will ever take away the benefits with respect to spread betting?
So the first one, I think, within the industry, it's difficult because we're a listed company and there's two other listed companies now. And if you look at our numbers, it's an interesting market we're in. It's profitable. The clients are they produce good revenue and they pay back quite quickly. So when the world went online, it's easy to try and emulate that business model. And we've been around 40 years and we're regulated in 17 countries and FCA. Whereas you can actually set up a business like this in Cyprus, be regulated by the lowest common denominator, and then you can just be a digital marketing gaming company targeting, my mother in Yorkshire, which is totally inappropriate. And so I think a lot of the problem with the industry has come about because of the advent of the internet and indiscriminate marketing. It's bad actors in this space. And so the FCA put out a paper for people that didn't know in December that talked about this, and our share price dropped by about $1 billion. It's recovered somewhat now, but it was just a hit on this leverage market and indiscriminate marketing to unsuitable customers. But for half of our accounts, we don't. So 40% of our accounts have limited downside risk. We give they can't lose more than their initial deposit, and we've chosen to put that in place. We've also got suitability checks, so not only on the investment side, on the trading side. If you don't pass the suitability checks and the MiFID checks, you don't get an account. So unless you've traded before and you've got experience, or you've worked in the industry, you don't come to us. So we've really raised the bar voluntarily, and we're not really in that end of the market that's affected. And I think, going back to my concentration point, 10% of our clients, or 7% do 80% of the revenue. Those clients are pro. They're the clients that, when they take other platforms, they graduate towards us anyway, because we're perhaps the safest counterparty, etc. And so, can we stretch to it? I think because our clients are different. Our clients are the more knowledgeable, sophisticated end of that market. And our big clients have been with us 3-5 years plus. They're not, it's not a churn business at that end. I think we can definitely do that, and we've got permission to do that because we tested it with them. As for the industry, no, I don't see it as bold call. Perhaps I don't see it being ruled out. I think suitability in everything that we're doing, whether it's investments or trading, is key, and I think that's the problem with the industry. So I think for suitable professionals that, if you're targeting correctly, and you're not sponsoring sports teams, indiscriminately marketing to anyone and any old Joe, if you're doing it properly, then I think the regulators and the FCA are comfortable with that. They don't care about professional, wealthy clients. They care about the average retail client that is unsuitable for the product. And I think
I was thinking more about the fact that they took away the tax benefits. That, of course, one of the benefits you have now is you can build out this new business because you have the base. And your point was that the new incomers, of course, have to get there quicker.
Say that again.
So basically, if they took away the tax benefits on spread betting,
right, on spread
that
betting,
would actually take a lot of, obviously, your current revenue away.
Yes, I think spread betting is just a UK phenomenon. So half of our revenue is ex-UK, and that's just CFDs. So CFD is a legitimate way to go long or short and get leverage. And equities is perhaps 10 to 1, and you don't need to take that. So I think CFDs still exist without spread betting. Spread betting is a great tool because capital gains tax free. So if you look in your portfolio, you SIP, right? You want to load up your SIP to have enough to retire on, but not overload it. Then you want to go into an ISA so you don't get any income tax on the way out. And then your spread betting is an efficient tax-wrapped account. But if spread betting didn't, would it get more tax revenue for the government? There would be losses as well as gains in that. So.
Any other questions?
Out of the many countries where you operate, where do you have the most turnover velocity?
From trading?
Customers? Yeah.
Outside of the UK, maybe.
On the trading side?
Yeah. Greece, are you in Greece?
No, not as an office. No. Germany's quite big. The DAX is a very interesting product for us. It's more volatile than other indices, so that trades a lot. I think the velocity of trading is pretty consistent across the board. If you look at our client base, we're not in North America, we're not in South America, but we're pretty much the rest of the world. I think the difference we see is the intraday trade. So Asia is very much a currency-driven market. The UK, there's a lot more stocks and perhaps indices in there. But I think it's pretty consistent if you look at the clients we have across the world. From an investing product, we're absolutely not going global. The UK, we had such a dominant market share, it was growth, and the market is ready for this, and we think it's a good market to go into. Whereas in Germany, you can buy an ETF or a share for €5 a trade through your bank, who does your car loan, your mortgage, and you pay your salary into. What are we going to do? Go in and offer it for €4 a trade as an English firm? I think, it's not one size fits all. Australia is interesting because we're dominant there, but probably UK and Australia for the investment products is where our focus is going to be.
Last question from Peter, and then we must finish.
One area you could differentiate yourself on the ETF side, to the extent you build investment portfolios, is obviously you've got systems and customer bases. There's a user of big leverage on one side of the business. Would you propose to get to the point where you're providing at a much lower AUM level leverage against invested portfolios that the larger banks do for their more high net worth clients?
To help clients take that as collateral against their leverage.
Yeah, it's the cheaper, lower cost of
Yeah,
borrowing.
so on a stockbroking client base, if they've got positions and they don't want to sell those positions for capital gains tax or whatever, we allow them to hold those positions in share dealing, and we collateralise that and give them very, very modest leverage against that. We wouldn't do it in a tax wrapper. For example, if your positions are in a SIP, that's long-term protection.
Yeah, but if someone just holds physical ETFs, LTVs of 30% against that?
Yeah, so we'll do a very modest mark to market on that and use it as collateral. Yep.
Excellent. We're running out of time, so I'd like to say thank you very much, Ian. Very grateful. Thank you.